welcome to the CNBC TV18 Investment Guide. I'm Surabhi Upadhyay, and with me this week is Nigel D'Souza. Now, Nigel, over the last couple of days and weeks, actually more of last week when I was actually on leave, the market was roiled by this big worry around bond deals. Suddenly, we were so worried about rising interest rates in the US and in India. And we saw that play out, which is why we thought, let's take this theme up on Investment Guide and try and figure out if this really is a matter of concern for the market.
Well, Surabhi, you said it. The last week or so, I tell you what, the bulls will be so happy to see the spike in bond yields. I'll tell you why. Because that's what provided the perfect opportunity for them to enter. But there's so much of debate out there. In a rising yield environment between the, the early 2000 odd, that's when we saw the highest amount of growth, highest amount of earnings upgrade as well. So plenty to discuss in the next half hour odd.
So let's get with it. Here's the CNBC TV18 Investment Guide. Well, our guest on the show today is Aditya Narain, Head of Institutional Equities Research at Edelweiss. Now, Aditya is someone who's, of course, seen this market over cycles. And Aditya, I'm very sure you will remember the heydays between 2003 and 2008, right? At least I remember. And at that point in time, rates would go up and, we would talk about overheating. Bond yields were higher. The bull market didn't care. But before we get to our first question, Aditya, let's actually illustrate the point by just looking at the simple picture. So if you're looking at the charts really and look at what the benchmark yield, the global benchmark yield, the US 10-year has done, then this is the last 1 year. It was absolutely steady because remember the Fed has been promising that it's not going to move on rates. It'll be very accommodative in its policy stance. But then what happened here? The Fed is still saying the same thing, but the market started getting very worried about inflation because there's a fiscal stimulus coming through as well. And therefore, in the last 3 months, towards January on to February, this was the peak. Intraday, that level on Friday, last Friday, went to 1.6. And that's really where all the concern started coming through. So now this is what we're talking about. The market anyway has receded from those worries and those fear points. This week, we've seen a catch-up rally. So therefore, Aditya, the first basic question, was this just an overreaction? Was it unnecessary panic?
I would tend to believe the extreme moves both in the bond markets and in the equity markets that followed. I think they were a little bit of an overreaction. As you put it, I think yields rise for two reasons predominantly. One is if inflation risks are very high, then they rise. When that happens, that's typically obviously negative for bond markets, but that tends to be negative for equity markets also. The second scenario that you get to see, and which is what you saw in the 2002-2004 period, is that growth starts looking good, and because of that, bond yields rise. So in this latter scenario, that is actually typically fairly good for equity markets where rates are rising because growth is tending to be strong and expected to move up, right? At this point in time, the big adverse reaction you saw was that people got worried more in terms of the risks of inflation rather than inflation data coming through. And that's not good for bond markets because either if inflation comes through or if perception of risk remains high, that can be a little bit of a negative. But that's also why the reaction was probably overdone, and you've seen both yields come off and equity markets bounce a reasonable way back.
Well, Aditya, are rising yields though a worry or not? Because I remember, everyone keeps talking about 2003 to 2008. Well, that was the best period for equity markets. So wanted your take on that.
So I would say at this point in time, I don't think it should be too much of a worry. See, there is always a trade-off, right? If you are getting growth and you are getting rising bond yields, I think you're sitting pretty. If you're going to get inflation risks without growth coming through, which is bad for markets, I don't think that is something that tends to sustain for an extended period of time. So in that context, I wouldn't worry about it too much at this point in time. I might add there's a third element of this which also comes into play is whether you have a flow issue where there aren't enough buyers of US treasuries and so bonds tend to go up. That's a little bit of a new risk that's coming up, but we've got to wait and watch for it. But X of that, from a more conventional perspective of inflation being the risk, I think it's been a little overdone, the sharpness in terms of US bond yields. Will they retrace all the way back to 1%? I'd be a little surprised about that.
Okay, take that point on board, Aditya. But you know what? They also say that history doesn't always repeat. It more often rhymes, right? So I don't know. I mean, should we not be a hostage, a prisoner to history as well? Just because in 2003 bond yields went up and interest rates went up, equity markets went up, is that too simplistic a view to have that we'll assume the same thing happens again?
No, I think you're absolutely right. I think one has to be very, very watchful, right? But whether the extreme move was necessitated or not is what, because there wasn't enough data point on the other points on the other side to suggest that was the case. But I think every cycle it's not a question of repeating itself or rhyming, with it or not. The reality is every cycle tends to be a little different. Every cycle, quite honestly, is dynamic, so things can change along the way. So I think that's something you really need to keep an eye on. But pure inflation risk-driven concerns without, inflation showing through, I think that probably was a little in excess. But it's clearly something that you need to watch. In fact, to be fair, I think one of the big negatives for equity markets is if you actually see inflation go up and growth go down or not come through. That's like before the growth cycle has started. If you've got inflation-driven yields going up, that can be actually bad for markets.
All right, Aditya, earlier you said that at current levels, the yields are not a big worry. So at what level then do you believe that the yield becomes a bit of a worry?
So I think again, as far as markets are concerned, they tend to react predominantly to direction. So I think this 1.3, 1.4% that you're probably likely to settle down at, that is fine. I think if you start seeing it trending up, because now the base has been reset higher, I think 1.7, 1.8 is where it starts becoming a worry. If it reaches something like 2%, without the growth acceleration that people are hoping for, I think that's when it starts becoming a major worry.
Okay, got that point. Now, Aditya, also, I'm going to ask like a dumb question, right? Because you keep hearing a lot of fancy phrases in market talk every now and then. And nowadays, one always talks about the quote-unquote reflation trade. Then there is the economic recovery trade. So tell us, are both similar, different, and which is the right trade to play, basically?
No, I think jargon will never stop. It keeps evolving like the markets and thinking on markets. So I don't think there are hard terms or hard definitions for each of these. Mm-hmm. But if I were to fundamentally split them, then the economic growth trade is simply that growth is looking good. You're going to have an extended period of economic expansion and therefore earnings. And that tends to be a longer term trade. It does not play through immediately. It's as you get more and more comfortable with the growth, as you see more of it, you start paying up more and more for it. So that's one part. The reflation trade typically is a shorter term phenomenon, and I'd break it into two. One where you have undervaluation that catches up, which happens very quickly, or if the rate cycle changes or rate levels tend to change, then there is a bump up in terms of valuations. So the big difference is that one is based on the underlying economy and tends to be more extended. The other, which is the reflation trade, is more a valuation phenomenon, more a monetary phenomenon, and tends to happen much quicker.
Okay. Well, all right. Then on that note, though, we'll slip into a short break. We have Aditya still with us. We have lots more questions to ask him on the other side. You stay with us. Welcome back. You're tuned into Investment Guide, and we have been discussing the rise in bond yields and what's the potential impact on various sectors. Aditya Narain, the head of institutional equities research at Edelweiss Securities, is still in conversation with us. Well, Aditya, let's get a little sector specific. Given the fact that yields are going to rise a little bit, maybe inflation picks up a little bit. The big performers of the last 5 to around 7 years have been those cash-rich FMCG companies. Is it time to look beyond them? Maybe, in fact, look into some of those cyclicals. Your take on that?
Yeah, so I think, again, since a lot of this is focused on bond yields, right? If bond yields are rising purely because of an inflation phenomenon, or as I said, a supply of treasury issue, then that might remain a relatively safe place to stay. But I don't think that is the case. And so to that extent, you should actually look at businesses or sectors that are a little bit more geared to growth and with the underlying belief that some of the rate hikes that you're seeing or the bond yields that have gone up are reflecting a better growth environment. So in many senses, we would tend to believe that it's better to be on the growth trade, deal with slightly higher bond market yields. That doesn't necessarily translate into higher lending rates for India, but just go that space where actually you pay a premium for growth because you start seeing it come through, right? Again, these things can change, but as I said, if it's only an inflation-led worry, that can be a challenge for the growth trade, as it were. If it is a little bit more balanced between a little bit of inflation and a certain amount of growth uptake, and I think in that balance, I would still go for the growth sectors of the financials and the industrials.
Okay, got that rationale, Aditya. So let's expand on that point. So I mean, if you were to help us construct the right portfolio as per your analysis at the moment, what all would go in it? Key overweights. Since you're looking to play for growth, how are you looking at doing that? Metals, cement, banks. How do you go about it?
So the way we are seeing it is that our primary picks, which are driven by this theme, are really the financials, the industrials, and real estate, right? So these form the bulk of sectors that we think moving up, that we think are reflective of growth, and that we think can deal with a slight increase as far as rates are concerned. The rest of our portfolio really revolves around the IT space, which has very little to do with the rates, other than the fact that it should fundamentally reflect a good overall global economic environment, right? Their dynamics are different. This sector will be less sensitive to rates, but will be sensitive to growth in the global economy. The one space that traditionally falls into this would be the commodity space, which has done very well in spite of rates being a little higher. We've cut that to a neutral because we think individual stocks have moved up a lot, but fundamentally they are also very leveraged to the growth trade, as it were. And they are also, as I said, able to withstand a certain amount of interest rate increase as long as it is premised on growth rather than inflation or bond supply considerations.
Okay, yeah, I know commodities. I mean, we have our own, metal king right here, and Nigel's been telling us just that, right? I mean, all your metal companies are raising prices like anything. All the auto guys, everybody else is complaining, and even in China, I mean, the price rise is just not stopping, right?
Surabhi, every month, from maybe November onwards, we said this price hike is done. Then we had December. Then suddenly in January, everyone said we got it right. Prices, see, they've started correcting. But come February, there's been a price increase, and come March, I hear that maybe in the next couple of weeks there could be another price increase. So that's telling you the kind of cycle we are in terms of metal stocks. Well, Aditya, let's talk about Aditya, you're making a point.
Yeah, if the price hikes for metals are anything to go by, right? Presuming there's no big supply disruption as far as the metal space is concerned, then it is telling you that you have a very robust demand cycle out there.
Yeah.
Right? I would moderate it a little bit, and that's why we moderated our view on the commodity stocks also. Simply because I don't think you're getting a corresponding uptick in broader growth which would support this. So what you'll probably get is commodity prices settling off or easing off a little bit, and the rest of economic momentum going up. But there needs to be a balance between the two. If you were to go only by commodity price hikes, then one could argue that this is looking like a really strong growth-led environment, which means these interest rates are very, very palatable as far as the equity market is concerned.
Yeah, but let's face it, it's not just commodities that are going up. There's also crypto, right? So there's a fair amount of this low yield, low dollar play to it as well. So perhaps, Aditya's absolutely right, I guess. It's not just pure demand. I'm sure there's a lot of that easy money that's fueling this big rally.
Absolutely, Aditya. But let's talk about the markets on the whole then. Do you expect 2021 to be a fairly volatile year? Volatility is likely to pick up even from here?
I think volatility in this new age is not going to go away, right? With flows being so dramatic, with guys like you picking on small trends so aggressively, with retail investors all over the place, right? And a lot of commentators out there. So I think volatility is fundamentally here to stay in many senses. It's just that, it's like a well-oiled machine. It's very easy to move stuff, very cheap, and everyone has a view and the ability to do something on the back of it. So I don't think volatility will tend to go away. Whether markets move up substantially or down substantially with volatility, I don't think that will be the case. I think you will have volatility, but around a mean which is not going to be very different from where you are at this point in time.
Aditya, speaking of retail, smart, young guys moving the market, I don't know, Nigel, if you caught this or not. I was just reading an article. Now in the US, there's going to be an ETF. What's going to be the criteria of companies that come into the ETF? Social media sentiment. Whoa. Which are the stocks which are buzzing on social media? You put them in an ETF and then you rally money around it. So we are in, absolutely uncharted territory. After GameStop and everything else that's happened, some really crazy stuff that's happening out there. Which is why I'm going to ask you this question now. Aditya, what is the biggest risk? We can't be in an environment where there's no risk, right? So what should the bulls on the street bear in mind?
I think inflation quite clearly is one, and we talked about commodity prices moving up the way they are. If they're not supported by demand, then you have a little bit of a challenge, right? Yeah. So I think that is a predominant risk that people have just got excited by seeing a sliver of demand come out, and they've extrapolated it a long way. And as I mentioned earlier, the last place you want to be in the equity market is when rates are going up and growth is going down or not coming through as expected. So I think that will remain a risk, and that's why the market's been so sensitive to this. I think the other remains policy, because again, what the US does or what Europe does or what China does, all those things flow through very, very quickly. And this is a dynamic world. There is a debate out there. In fact, it's interesting, one of the risks there is, if you looked at the the GFC, right? When there was a lot of pump priming and low interest rates, I would say 80% of economists on the street at that point in time were warning about inflation, right? This time, the pump priming has been even greater. Money has been even easier. And I'd just say about 20% of people are talking about inflation or warning about inflation simply because of what's happened over the last 8 or 10 years. So I think that can be a risk, that policy plays through and the market is too much on one side in terms of what to expect, given their experience as far as the GFC is concerned. And I think the third bit, which is very, very important, which is very important for India, but I think globally also, is, the world has narrowed, I think, a little in terms of demand, because the lower end of every economy has suffered from wages, either not moving or going down, or, people losing jobs. And in this first flush of demand and this first flush of getting back into the economic cycle, this pain is not seen. And I would look out for that over the next 6 to 12 months to see whether that pain actually starts translating into aggregate numbers. So far, it's not come through. From an India market perspective, my own view was that Diwali will flush out all the pent-up demand, and you really got to watch for this, this demand risk which sits at the bottom of the economy. That has not played through as yet, but I would not dismiss it. And I think this is true for India as it is for the rest of the world. So just to recap, inflation risks, policy risk and its transmission across markets, and the demand risk, given that the economy has tended to narrow quite a bit.
Yeah, I guess that's really important points Aditya is making, right? Yeah. Complacency, the biggest risk, I guess, is complacency, one-sided views, and then the market springs a surprise and you're caught off guard.
Yeah, I think in cricketing parlance, you're saying just come out there, you need to bat a few overs and you're going to be hitting, knocking in a few runs. I think that's the bit of a problem today. And every now and then you said, hey, the pitch is bad today, it's going to be a little bit better tomorrow, and that's precisely what's playing out. But Aditya, we're talking about cyclicals, and clearly the point you made is very valid, that the party for the metal stocks, well, it needs to be backed with some demand. Otherwise, it's just going to be, that money is being printed, prices are going up, and if it's not demand-led, there's going to be a bit of an issue. What about cement? The domestic theme, there's so much of talk, and we've had a good February. I was just checking some data. That's looking quite good, actually. Your take on it from you, and price increases have not really come about. Yes,
let me just add my question to that. Since you are positive on real estate, how do you sort of marry the two? And are you convinced that whatever real estate demand we're seeing is not just pent-up work-from-home demand, that this is, a sector turning, a giant sector turning?
So I would say, specifically to answer your real estate question to start with, I think the sector has turned, right? Now, whether it will continue to see this accelerated demand, I don't know, but I think it has kind of bottomed out. Whether it's turned enough to see price rises, I don't think so. But I think as long as you start getting volumes, I think that's the healthiest thing that you want for an economy, which is real estate starts moving, there is transaction activity, there is money that moves, and people have jobs to actually build and construct. So I think in many ways, this is the right place to be from a real estate perspective, where you're seeing volume, but you're not seeing price. Otherwise, then these inflation risks and ability to purchase risks start coming through. So that's a sector we generally like, with, as I said, the presumption or the belief that it is turning, but it is turning without price increases. To your point on cement, we're a little bit more cautious at a portfolio level. We've got it a slight underweight. Again, I think there are two elements as far as cement is concerned. One is, there is a gap between what you're seeing the largest companies which we track and we invest in, right, and what the aggregate demand is, right? Aggregate demand is still actually negative, even as the leading companies are doing very well. So, it's not such a bull run because it's more an allocation issue rather than absolute demand, right? The second thing is, I think these stocks have done well. I think you had very, very strong earnings that have come through. I just feel a little cautious in terms of valuing them up at their peak as you've had very, very strong earnings. So I think the theme to some extent is a little bit more like the commodities that you've seen. It's just that since this is more domestic, you can try and make a finer call rather than, your traditional commodities, which are so globally driven.
Okay, well, it's been a pleasure listening in to you, Aditya, and I think we'll have more clarity, more answers as we get into the next earnings season, right? Because that turns out to be the real litmus test with all the hype and all the expectations that stock prices have already built in. Thank you for your time and for joining us on the show today. Well, that's it on the CNBC TV18 Investment Guide for this week. It's a wrap from Nigel and me, and we'll see you again next week with a new theme.